Consider a 4% coupon Treasury bond maturing on the 15th of November 2025. For settlement of the 23rd of June 2021, the yield on this bond is 3.25%. We want to find the clean price, the accrued interest, and the dirty price of the bond, and then we want to figure out how much we would pay for $300,000 of principal of this bond. Now remember, the clean price, accrued interest, and dirty price of the bond are going to be for $100 of principal, which means we'll have to scale appropriately to get $300,000 of principal. Okay, so I've set up a little bit of an Excel sheet to put my information in. So it's a 4% coupon bond maturing on the November 15th, 2025. Settlement on June 23rd, 2021. The yield is 3.25%, and we're looking at $300,000 of principal. Now, the clean price, we're going to use Excel functions to do this. We're going to start with the clean price because we can just do that. So that's the function price. So the price takes the settlement date, the maturity date, the coupon rate, the yield, the redemption, so we're just going to do $100. The frequency, which is semi-annual because this is a U.S. Treasury bond, and the basis, which is 1, actual over actual, again, U.S. Treasury bond. So the clean price is fairly easy, 103.05. In order to do the accrued interest calculation, we need the previous coupon date and the next coupon date. So we're going to calculate those. Often I would do the accrued interest calculation all in one function, one cell. I'm going to break it apart so we can see the coupon dates. So the previous one, Coup PCD, takes the settlement date, the maturity, semi-annual, basis of 1 for U.S. Treasuries, and then Coup NCD for the next coupon date, same parameters, settlement, maturity 2,1. So this bond matures on the 15th of November 2025. It has coupons on the 15th of May and the 15th of November every year. The coupon rate is 4%, which means you earn 2% of par of the principal you own every 6 months. Okay, the accrued interest is the interest accrued since the last coupon date. You calculate that with ACCR int. The first two parameters of this function are a little misleading. We don't want the issue date and the first interest. We want the previous coupon and the next coupon. And then it takes our standard parameters, settlement, the coupon rate, par of 100, frequency 2 for semi-annual, basis 1, which is U.S. Treasuries. The accrued interest is 42 cents. The dirty price is the sum of the clean price plus the accrued interest. And then the payment for $300,000 of principal. Remember these prices, the clean, the accrued, and the dirty. The clean and dirty prices are for $100 of principal. So we have to divide by 100. So that's going to be the payment for $1 of principal, and multiply by 300,000. And we find that this bond, if we wanted to buy this bond and it's got a yield of 3.25%, we would have to pay $310,407.80 for $300,000 of principal. Again, this bond is trading at a premium above par, above 100, which makes sense. It's got a 4% coupon with a yield of 3.25%, which means that the coupon rate is too high, which means over time we would expect to lose money in capital. Effectively, we invest $103 or so, and over time, over the next few years, that $103 would decay down to 100. We would be earning 4% of coupons per year.